home loan solution that's gaining in popularity.
It's a simple switch to help Australians keep their homes or get into the property market.
As thousands of Australians are struggling with the rising cost of living crisis and higher mortgage repayments, one home loan solution is gaining popularity. Hey everyone, welcome back to our channel. Today we'll be delving into the current cost of living crisis and specifically into the world of extended loan terms. We'll also discuss the pros and cons of switching to interest only, even some of the cash flow benefits. So let's get started. Firstly, let's understand what an extended loan term is. A loan term is the length of time that you have to repay your home loan. The most common loan terms are 25 or 30 years in Australia, but there are some lenders that offer longer term home loans like 35 or 40 years. There are a few reasons why you might want to extend your home loan term. For example, if you're struggling with your monthly repayments or you want to free up some cash flow for other expenses. The other reason people consider extending their loan terms in the current environment is that with a longer loan term, you have lower home loan repayments and potentially your borrowing capacity is higher. However, it's important to understand the risks and costs of extending your loan term before you make this decision. For example, let's consider a $500,000 home loan with an interest rate of 5.5% over a 30-year loan term. The minimum monthly repayment is $2,839. If we extend the loan term to 35 years, the minimum monthly repayment reduces to $2,685. That's a difference of $150 a month, providing some short-term relief for borrowers. It gets even bigger with a high loan amount. Looking at a $1 million home loan at the same rate of 5.5%, with a 30-year loan term, the monthly repayment is $5,678. But extending the loan term to 40 years, the repayment goes down to $5,158. That's almost a $500 a month difference by extending the loan term. But this is all going to come at a cost. Let's go through the risks and costs of extending a loan term. Assuming you make the minimum repayment, you will end up paying more interest over the life of the loan with a longer loan term. This is because the longer you take to repay the loan, the more interest it's going to accrue. While extending the loan term might reduce the immediate pressure of your monthly repayments, it's essential to consider the long-term implications, especially the increased interest costs over the life of the loan. For the $500,000 home loan example, extending the term from 30 to 35 years would result in paying approximately $91,000 extra in interest. And for the $1 million home loan scenario, extending the loan term from 30 to 40 years would add approximately $305,000 to the total interest paid. So on those numbers, it's really important to carefully weigh up the short-term relief versus the long-term cost of extending your loan term. And this is where it's just not that simple. Everyone's situation is going to be different. These figures are going to change depending on how long you hold the property. The average home in Australia is held for 11 years. In WA, it's as low as 8 years. So calculating these figures over a 30 or 40 year loan term might not be accurate. You need to sit down in your situation and work out what's going to work for you. The impact of interest-only repayments. In addition to extended loan terms, some people are considering switching to interest-only repayments as a means to lower immediate monthly costs. When you opt for an interest-only repayment, you're only paying the interest portion of your loan each month. The principal amount or the amount you originally borrowed remains unchanged. This means your loan balance stays the same and you're not actively reducing your loan or your debt. Let's revisit the $500,000 home loan example at an interest rate of 5.5%. With a 30-year loan term and interest-only repayments, the monthly repayment would only be $2,292. Giving some short-term relief. As I mentioned, it's important to note that the interest-only repayment only covers the interest portion of the loan. The principal or the $500,000 you originally borrowed remains the same. This means over time, if you're paying only interest only, you're going to pay way more in interest over the life of the loan. Fortunately, with these scenarios, there can be a little bit of a best of both worlds. It is possible in a lot of cases to make extra payments on extended loan terms. As I said before, this video isn't about what's right and wrong. It's about giving you the tools and the education to understand what's going to be right in your situation. There are drawbacks to extending your loan term, like paying thousands in extra interest. But as I mentioned, if it's the only difference between you losing your home and not, it could be your only option. While extending loan terms may come at increased costs, there is a strategy that you could consider to mitigate all of these expenses. You may choose to extend your loan term to 35 years to have some reprieve, and your minimum repayments are $2,685, as we mentioned earlier. But you can simulate and increase your monthly repayment to be the same as if it was on a 30-year loan term. You can increase your monthly repayment even though you're paying off technically on a contracted 35-year loan term. In effect, you'll save 5 years off your loan. Instead of it taking 35 years, it'll only take 30 years. And you'll save those extra costs you would otherwise pay by taking the longer amount of time. By making these extra repayments, borrowers can potentially save an amount on the interest and pay off the loan sooner. It's important to work through these scenarios with your mortgage broker to see what's going to suit your circumstances best and meet your goals. When considering extended loan terms or interest-only repayments, it's important to assess your future situation and long-term goals. While these options can provide temporary relief, the reality is they're potentially going to result in higher overall costs in the long run. The first thing I'd be asking your bank or your broker is if you can easily switch back and make extra payments if you change your loan structure or extend your loan term. The point of this video is if you're borrowing for a longer period, say 35 or 40 years, the repayments may be less, but it could cost you more over the long term. The impact of these costs can be quite substantial as the interest compounds. If you are considering extending your loan term or looking at interest-only options, as I mentioned, it's going to come down to your circumstance. If it's the only chance of you keeping your home, then it could be worth considering for the short term. Other factors I think you need to consider are also age. If you're younger, you're potentially going to stay in this home for longer and it's going to cost you more interest. So work out what impact that's going to have and potentially how much equity that will erode over the next 5, 10, 15 years that you keep this property. Your expenses. If you are considering making these changes, try and have a look at your other expenses, your monthly statements. If there's anything you can cut back, I'm sure you're across it, but extending a loan term isn't available with all banks, and equally going to interest only is only available with certain banks in particular circumstances. So you want to have made sure you've looked at all options before you go down this route. In situations like this, you don't just want to have a knee-jerk reaction where you're worried about the market or what's going to happen. Think about your situation and try and think ahead 5, 10 years on where you're going to be and how you're going to be placed. How are you finding the current climate? If you're a first home buyer and wanting to know more information about the cost of getting a loan and how to get into the market, hit us up at Hunter Galloway. We help home buyers across Australia. And if you've got an existing home loan, if your repayments have gone up and up and you're wanting a bit of relief or even want to look at other options outside of your current bank, then we'd love to help out. At Hunter Galloway, we help homeowners and home buyers all across Australia. There's no fee for our services. We're paid by the bank upon settlement. There's no cost to you. So yeah, hit us up. We'd love to help out, potentially get your rates down, help make those repayments a bit more affordable, and ultimately help you pay off that loan a little bit quicker by structuring your loan in the right way. That's it for today, guys. Hope you enjoyed the video. If you did, leave a comment below. What did you like best? What would you like us to cover in the future? And until next time, see you later.